Right, good afternoon. My name is Chris Wilkins. We're the accountants to Bolt Angels, we're the accountants to Steve. We've been in place for about a year. There's three subjects I was going to cover. One is your question. One is to tell you what Rachel Reeves is going to do in the budget, and three is to answer any questions. So let's start off with the process at the moment. So at the moment, you've got an asset. So let's say let's do it really simply. I've got four shares that cost, four shares, four different companies. They cost £1 each. And let's say they're worth £1 million each today. So my limited company owns those assets. So if I sell one of those, then I've basically made £1 million. The limited company pays corporation tax on that £1 million. And the current rate of corporation tax on £1 million will be 25%. So that means you end up left with £750,000. Then Paul, you'll say, I want a distribution. Can you give me a dividend on that? On that level of income, you'll get a dividend at 39.35% after the company's already suffered 25% corporation tax. So for you to get that money, you haven't got £1 million to distribute, you've only got £750,000 to distribute because the corporation tax has been paid on it. So therefore you can only distribute £750,000 and you're going to suffer, at that level the distribution will be suffering at the highest rate of dividend tax, which is 39.35%. So you've got double tax. If that is in an LLP is a limited liability partnership, that only pays income tax. So therefore the distribution from that would be a maximum rate of 45%. So you've got one figure of 45, or you've got 25% plus 39.35%. So it avoids that aspect. However, what you've got to do is take the asset out of the limited company and put it in an LLP. So you transfer it market value. So what David was saying is that would give rise to corporation tax. So the assets are being valued at the moment. Now, what Steve is saying is the assets will lift, hopefully, cross fingers, they will go up in value. But as of today's date, they're not going to be worth hundreds of millions of pounds, which is the proposed sales price. So you do have a personal point of view, you've got a personal capital gain and inheritance tax advantage that you can take out of this on this valuation. But depending on what the valuation is, the company, according to those figures, has 1.2 million of corporation tax losses already to offset against the sale of the assets. So whatever the sale of the assets are, and I don't know, whatever it comes out to be, then the corporation tax will broadly be based on that figure, say it's 2 million, I don't know, but say it's 2 million, less 1.2 million of losses, which means then you've got a taxable tax liability of £800,000 at 25% is £200,000. So whatever that number is, that's what you've got to build in your equations for your cash flow.
Yeah. Sorry, can I ask a follow-up?
Okay.
Thank you. I understood that.
Okay.
Thank you.
Okay.
That's positive. That's the benefit. Is there what's the risk? Most things have a risk attached. By moving from a limited structure to an LLP, is there a risk for the shareholders today?
Well, you've got to have a new structure. You've got to set up a limited liability partnership. The asset has to be sold at market value, and that's why they're having a valuation done. But both entities are limited. You've got a limited liability company, you've got a limited liability partnership. So both have the veil of incorporation protection. The accounts both get filed at Companies House. They both virtually be very similar sets of accounts, although it's similar structure. Limited liability partnership doesn't pay double tax, doesn't pay corporation tax, and you pay income tax on the distribution. It just pays income tax. But both of those entities, the accounts get filed at Companies House. So from that point of view, the limited liability structure is still in place.